This is Josh Jalinski, the financial quarterback. Don't touch that dial. For those just joining us, I'm Josh Jalinski, the financial quarterback. With David Ranson, inflation persists. Now, for those of you who don't know David Ranson, he's one of the few people I've interviewed, thousands of people over the years. And he was one of the few people years ago who said we would have inflation persistently. So I would say, I want to get a t-shirt that says Ranson was right, because we've had so many really great guests who got the inflation, deflation thing wrong. But Ranson didn't. And he's had a great track record as an economist, spent time at University of Chicago. We're going to get to his background and his inflation update. And we'll talk about stock market forecasts and predictions. What can we learn? Is there any science to forecasting? Can forecasting in any way be accurate or be a little bit more accurate than weathermen? So before we get started, for those who are not familiar with your work, David Ranson, describe your background.
Okay, well, I'm English originally, came over to the US for graduate school many, many years ago, and stayed in the US ever since. I went to the University of Chicago, and after that, I was with Boston Consulting Group for a bit, and then I had a chance to go to join the Nixon administration. George Shultz, who had been the dean of the Chicago Business School, became Secretary of Labor and the Director of the Office of Management and Budget, and was the key economic leader in Nixon's administration. And I joined in as a staffer. So I was in Washington for quite some years. Since then, I've come back to the private sector, and I've been, I joined H.C. Wainwright & Co., and I'm still with it today, although it's gone through many, many changes.
So you were a swamp creature.
Well, briefly, I was a political appointee, not an employee, not a regular employee.
So did you like working for George Shultz?
I loved that, yes. But there was an awful lot of opposition inside the administration, and a lot of blood was shed in debates and disputes, and I didn't like that.
So let's talk about inflation. You were right on inflation. What is your new inflation forecast? Why does it seem like inflation is cooling?
Well, as I say, the big insight is that geopolitical risk lowers the price of energy. It's very easy to show it if you take a look. It's very similar to the effect on the stock market. When you have risk elevated, you see it in the VIX index, for example, and then the stock market is held down. There's a tremendous relationship statistically between the S&P and the VIX index. Well, it's the same with other commodities, not just equities, but commodities. And oil is one of the largest selling commodity, of course, in the world. So we can watch the price of oil change, and we see uncertainty as inversely related to it. In other words, an increase in uncertainty, which is going to come from any geopolitical outbreak of risk, is going to depress the price of oil. And when you do that, you're depressing the prices of energy, all energy products generally across the whole world. And that pulls down the cost of doing business throughout industry, and you get lower prices as a result. But it's temporary, and it's driven entirely by the height of the anxieties that we're all feeling about the world political situation, particularly the Middle East and Ukraine.
You believe due to geopolitical risk, energy prices are artificially held down, which is why our inflation number looks like inflation's cooling, but it'll get hotter.
Yes.
Solely due to geopolitical risk, is there anything else that gives you that,
Well, the thing that drives prices back up again is the normal mechanism for inflation, which is a depreciating currency, a currency that loses its market value in terms of gold. And gold is the only commodity that will serve to measure the value of a currency in real terms. All other currencies are just as unstable as the dollar, if not more so. You've got to use a commodity whose real value is as constant as we can possibly expect. And there isn't any other commodity that matches gold in its constancy over time. We're talking about millennia.
If I'm looking at a chart to prove this thesis of yours, what should I look at?
The best chart to do it in the one quick go is to plot the inflation rates of a large number of countries, some of which have extremely high inflation rates, against the price of gold in each country measured in its own currency.
Because I always get confused by your gold Ranson ratio. I mean, obviously you were right because we've been interviewing you for years now. And when others predicted deflation, you predicted inflation. You're either a contrarian or you're a genius. So
I think inflation has always been associated with a decline in the dollar or any other currency in terms of gold. And that remains true today. But the process can be interfered with if there's a large enough effect through warfare or geopolitical risk in bringing the price of energy down, because energy is so central to the way economies behave. The price of energy dominates the price system, at least temporarily, while the price of energy itself.
Are you able to share that chart? Because I'm dying to find.
Yeah, tell me how. I'll click on share. This chart proves the point in one fell swoop. I've done lots of other stuff that's confirmed it, but this is the one that probably makes it as plain as it could ever be. I'm looking at a lot of countries. Most of these are in the emerging world because that's where you get the highest inflation rates typically. And what I've done is to plot the inflation rate annualized over the last 30 years here. The chart's an old one, and it's plotted vertically. That's the consumer price inflation rate. So Brazil, you'll see in the top right corner, has 100% per annum inflation rate on the average over that time frame from 1980 to 2012. And then the annualized price change for gold in local currency is measured along the horizontal axis. That's my point, that the inflation is directly and very exactly proportionate to the price change for gold, which is another way of saying that inversely, the depreciation of each currency in terms of gold over the same 32-year time frame.
So because gold is going up, inflation will continue to go up. Is that essentially what you're saying?
Yes. You sometimes have to wait 32 years to see it as clearly as this graph shows you, but sometimes you'll see it right away. It all depends on whether something intervenes or there are some lags as well. But the major thing that can intervene is geopolitical risk and warfare.
So if I'm looking at some indicator, what indicator would you point me to?
Two indicators. I'd look at the price of gold in dollars and the price of crude oil in dollars. Crude oil will summarize all of the energy prices, and gold just measures the depreciation of the dollar itself in real terms. Those two by themselves are enough.
Okay, so gold is $2,442 has gone up 26% the last 1 year. Does that mean you believe in a year from now we're going to have a 26% increase in inflation?
I don't know how long the time frame will be. If we didn't have a war going on in Ukraine and potential wars in the Middle East, then the answer would be something close to yes. But we don't. We have these things that are pulling prices for energy down, and then they're masking the inflation, which we are seeing disinflation as a result. But I can show you how the price. You asked me which indicators would I look for. You're seeing here, year by year, for the last 12 or so, 13 years, the rate of inflation measured by the most sensitive indicator that we have in widespread use, which is the producer price index. You can do this with the consumer price index, but this gives you a much clearer answer. Consumer prices just do the same thing, less so, and with the
you're
lag.
overlaying the producer price index to what?
The formula here includes the change in the price of oil and the change in the price of gold. That's it. So you can explain what's happened year by year to inflation. And you can, to some extent, anticipate, but you can't anticipate very far into the future because we don't know what's going to happen to the oil price anytime.
But your chart shows a slope down. So that shows it's lessening.
That was what happened last year. Yeah. But in this year, it's too early to plot the annual figure for this year. It'll be bounced right back up again. It already has bounced beyond the 5% mark, but I think it'll go further, probably to 10.
Was there like a 12-month lag? So in 12 months, the Fed's going to say, oops, we made a mistake. We got to raise rates again.
Yes, there is a lag. I don't know if it's 12 months. It depends on which index you use, and it depends on whether you're using oil or gold. Gold has a longer lag. Oil has a shorter lag. But there are lags involved, yes. So if the oil price were to rise, that would have to happen by an easing of the crises in the Middle East, especially in Ukraine. But that is certainly foreseeable that it'll happen eventually, no matter what. But it's a question of how soon will it happen. If it were to happen now, we would see a huge bounce in this inflation rate for 2024 and 2025.
So if I'm on the FRED data, which is the Federal Reserve Bank of St. Louis, they do the producer price index by commodity. Do I look at that index, the producer price index by commodity, or a different index?
Yeah, that's the one I'm using. It's the one for all commodities combined.
PPIACO, correct?
That sounds right. I don't have it handy here, but that sounds probably right. It's on FRED. Yep.
So it slowed down, but now it's ticking up. But you believe because it's ticking up, there's going to be inflation, but it's masked because energy prices are declining.
Yes, let me show you another chart that will get to this point too.
And folks, if you're just joining us, we're with David Ranson, studied at University of Chicago. What did you do for George Shultz again?
Well, I wrote memos for him. I worked on the law of the sea negotiations, and I worked on the financing of the Social Security system, and a lot of smaller issues.
So, PhD in economics from University of Chicago, MA and BS degrees from Queen's College, Oxford. He's a very, very sharp guy. So if you have questions for him on inflation, let us know. We'd love to hear from you. You could message me and I will ask any question you have. Go ahead, Dr. Ranson.
What I'm doing here is to show you month by month the change. These are percentage changes. One is the change in the CPI, the red one. One is the producer goods index that we were just looking at, the green one, but now it's month to month. And the black one is the oil price. And I think if you look pretty closely, you can see months in which the oil price goes down, the inflation news deteriorates, and months in which the price of WTI oil goes up, those are associated with an acceleration of inflation. So month to month, it's going back and forth, back and forth. It's rather like a tug of war right now. I'm arguing that if the oil price were stable, this would not be happening and we would be seeing inflation flat out. But because of the oil price interfering month by month, the interference is less or more. We get this fluctuation. The oil price explains all of the information that's going into the Fed to make the Fed decide whether to raise or lower interest rates. It's all about oil. It's not about the economy.
So inflation persists. That's the headline. But there might be a lag. It might be 12 months. You're saying it's not.
Yeah.
We don't know the exact time.
Yeah, well, we can imagine the Middle East staying on fire for years to come. It's imaginable. I don't think it's going to happen. I'm more of an optimist. I think things will calm down in the Middle East. But Ukraine is another problem. That could go on for years too. We don't know. But to the extent things calm down, then the inflation comes back to show itself.
You look at the price of gold, the price of energy, anything else that you say, this is showing we're going to have inflation.
You don't need anything really else. I'm sure there are other factors that create or destroy inflation, but they're minor, and the Fed is not one of them. You can look for correlations between what the Fed does with short-term interest rates and the resulting inflation change, and it's zero. There is no detectable impact when the short-term interest rate is changed by the Fed, and this is true for the last 75 years. There's no impact, no detectable impact. I could not draw a graph to show you an impact. In fact, I've got graphs that show you there is no impact. There are many factors that might interfere with inflation, but none of them are anywhere near as important as the price of energy. And so I'm putting all of my thoughts into the price of energy. And it doesn't enable me to forecast what happens anytime soon, but it does say that once a geopolitical risk calms down, which it always does eventually, then we'll have the inflation that was being hidden.
What do you think inflation will be by year end?
Well, that depends on whether the price of oil goes up or not. That would be, you could derive that forecast from the graph that's in front of you here. But I don't know what's going to happen to the price of oil between now and year end. That's a 6-month time frame. No, it's not quite 4. I guess it's a 5-month time frame. That's a long time. A lot can happen in the next 5 months. And I don't know whether the oil price will be down or up. But my guess is always, I think, the underlying tendency is for the oil price to be back up.
Anything else you want to say on inflation before we move on to some other subjects?
Well, simply that I think it's widely misunderstood. It's widely mistaught in the universities. We knew what inflation was and how it worked much better back in the 1960s than we do today. Because in the 1960s, we still had the Bretton Woods price system for currencies based on the dollar, and the dollar's price was $35 an ounce of gold. Having thrown that away, there's nothing to replace it except some vague idea that we should have confidence in the government. And that's getting less and less. And so we're at sea. There's hardly anyone anymore who is expressing a valid view of where inflation comes from, what the dangers are, and where it's all going to lead.
What does inflation come from?
Depreciation of the dollar, which we can measure relative to gold, best of all. You can measure the dollar's depreciation in terms of lots of commodities, but each commodity gives you a different story. You've got to measure the value of the dollar in terms of the one commodity which has the strongest claim to being absolutely constant, and that is gold.
And where will it lead all this inflation?
Well, inflation will lead to chaos at the Fed. I don't know what the Fed is going to do when the inflation starts coming back. But inflation slows down the growth of the economy, so it's not good for us in terms of growth. We're talking about fairly a large amount of inflation, and the slowdown in growth that results is material. It's quite significant. It's going to lead to, it's a stagflation situation that we may be stuck in for a long time. We've got to learn the lesson of stopping the inflation and tying the dollar to something real instead of tying it to government discretion.
So you talk about the VIX often. A lot of people that I've known over the years says it's very hard to look at the VIX index and give any prediction on the market. You would say otherwise. Talk about that.
When the VIX jumps, which it does from time to time with an explosion of some kind of risk, you can't anticipate that because it is a big surprise. But when VIX is now high, you can forecast over an unknown period of time that it'll come back down again to be normal. And we see this happening over and over again historically.
Let me interject. To me, the VIX, though, is like it tells you something after the fact. So now the VIX is low. People are more complacent. Then all of a sudden, some economic calamity will come where the Fed will say, hey, we got to raise rates, and then it'll crash. You know what I mean?
Yeah, there are various things that push the VIX up. And we don't have anything working to do it right now. But addressing the forecastability of the VIX, you can't forecast the VIX before it jumps up, because that would amount to forecasting the big surprise that causes the
let's just look at the VIX index. July 5th, it was 12.48. Today, it's 18.71. So that's a 50% increase. That's just a return of volatility because some of the, NVIDIA type stocks went down, 15, 20%. Like, I don't see any calamity that caused it to go up. And then just as quickly as it goes up, it subsides. Like the VIX was 18 in the little April swoon. You could argue that the peak VIX within a 6-month period or 3-month period is a good time to usually buy into equities.
Yes, that's what I'm saying. That's the forecastable part of it, especially when it's at a peak. That means that uncertainty is at its highest. And uncertainty is bounded. You can't just become more and more uncertain indefinitely forever. You have to get to a peak, and then uncertainty will decline. That's the forecastability of not only VIX, but any other measure of implied volatility in commodity markets.
The price action in the VIX would show that volatility subsides?
It always does eventually, yes.
No, but I mean short term. The VIX is a little high relative to where it's been all year.
Well, 18 is not very high. You mentioned it was a 50% increase from 12 to 18. I would advise not doing the calculation that way. VIX is a measure of uncertainty. It's the standard deviation of the frequency distribution a month or 3 months from now of the S&P. If you want to measure the size of the VIX increase, you subtract 12 from 18, and that's 6 points. And that isn't a very large increase in VIX. If you add another 6 points, you get to 24. Another 6, you get to 30. Now we're talking about a seriously high VIX, but that's how many points it takes to get VIX to be high. To go from 12 to 18 is rather a small change.
But I'm just looking back. The last time it was above 30 was in the little swoon of 2022, which probably not a bad time to buy stocks. But what's interesting here, it was also 30 December of 21 when things were pretty high, and then fear subsided, went down, and then rocketed up again in early 22. So what does it tell you where it is today?
It's moderately low today. It's not dramatically affected by the geopolitical risks that have this massive effect on the price of oil. There's the S&P index. These are percentage annual changes. SPY is the futures, the exchange traded fund that you can buy and sell to buy and sell the S&P. So you can see the SPY and the S&P 500 move together. Now the red line is the VIX index. These are percentage changes. And you see very clearly, I think, how inversely related the VIX is to the S&P. That's one way to show it over a long, long period of time. This uses the entire history of the VIX index.
But the VIX doesn't really tell you when to buy, except after it peaks. Like right now, the VIX doesn't tell us whether the stock market's going to go down or not, because the rate of change from 12 to 18 is not significant enough. Is that correct?
Yes, it's not significant enough to...
It shot up maybe quickly in the next week to 30. Maybe you do sell equities because you wait. It seems like by my reading of the chart, there's an initial spike in the VIX, greater stock market volatility, maybe a crash, then an absolute peak VIX. And then peak VIX is almost like when to invest. I kind of see what you're saying, but I also see that it bounces around from 12 to 18 to 30. And
yes, I don't advocate trying to use this to forecast the stock market unless it is extremely high. And even when it's high, there's still a chance it'll go higher still, and that'll work against you. But as long as it's high, you have a very good probability that it'll be back to normal in less than a year or so. You might have to wait that long. but that is a very sound, very solid forecast. It can get as high as 30, 40, 50, even 60 or 70, I believe, at times. But they're rare events.
Yeah, like COVID.
Yeah.
What is a normal garden variety correction? 30?
Well, 30 is already pretty high. The chances that if it gets to 30, that it's going to go higher are limited, but they're not zero.
So what about 24?
That's getting high too, yes.
But when would you say, okay, so the market's down today, was down 650 points, on track for the biggest sell-off of 2024. The market was down about 494 points as of now. NASDAQ down significantly, Russell down significantly. VIX is up significantly, 12% today. What's your short-term prediction on the stock market?
Well, short term, I don't really have a strong conviction. Longer term, let's say a 1 year time frame, I have a basis, and VIX is part of the story, that the market will produce a normal rate of return in the next 12 months, something like 10%.
Why?
Well, the things that drive the stock market are the price of oil and the price of gold. Just as they forecast the inflation rate, in a graph I showed you before, I have graphs that show how they work for the stock market as well. In fact, I can find that pretty quick.
Yeah, send me that. Send me all these when you can, because these are pretty powerful stuff.
This is more challenging as a graph. If I've not shown it in a time frame, what I've done here is to produce it. You could call it a scatter plot. Each red square is a point on this graph. It's like a map, really. And it refers to 1 year's experience with the stock market. Notice the two axes. The vertical axis, the label is prior year change in the oil-gold ratio. The horizontal axis is prior year change in 20-year, that should be forward gold. So I'm using the forward gold price. The change in the forward gold price is a measure of inflation. The change in the oil to gold ratio is a measure of the extent to which the oil price behavior, which is largely due to geopolitical risk, is interfering with the inflation. But if you can have a situation in the top right corner of the graph where the oil is up relative to gold, which is in more inflation, and the price of gold itself is up also. So the worst conditions for inflation are in the top right corner of the graph. And they would be the place where you would get the worst stock markets. Well, the nearest point on the graph is labeled 2021, and we had a minus 1.8. That was the worst stock market we had in this limited time frame here, about a decade. Let me go on by looking at the bottom left corner where we don't have any data points. That would be the best climate, where the price of gold has gone down and the price of oil has gone down even more than the price of gold went down. So you're in the bottom left corner. And the nearest data point to that is fairly far away, but it's 2020, and the stock market return for that year was 35.7. So that was the best outcome for the stock market. So there's a coordination here. The graph explains why some stock market years were good, others were less good, and in between. It explains, in fact, a large fraction of the variance. So this is based only on the price of oil and the price of gold. I don't even use the VIX index.
Let me dumb it down. So when oil is low and gold is low, that's a generally a good time to invest in stocks?
Yes.
When oil is high and gold is high, that's generally a bad time.
Yes.
But because now gold is high and oil is low,
right,
it's sort of like a Goldilocks scenario of 10%, which is why your forward forecast for 12-month equity returns is somewhere around 7 to 10%.
Yeah. You see it in that blue star. It's dated April, but I've recalculated for the end of June and it hasn't changed position. That blue star lies not at the bottom left or at the top right. It clearly lies in between. And that is a normal, an average rate of return on
So
stock.
we're sort of near an average. But what about like what you're saying? If we wake up and we have inflation 6 months from now or 12 months from now, the Fed comes back and says, you know what, we were wrong. And Dr. Ranson was right because this inflation easing is due to energy prices cooling, due to geopolitical pressures and I don't know, opening up of the reserves. I don't know if that makes an impact. Wouldn't that cause the market to crash a little bit?
Yeah, that would not be good for the market.
Doesn't one of your theories contradict with the other?
No, as the oil price comes back up, then you're higher on this graph and you get to lower and lower stock market results. So the worst one in this graph is minus 1.8, but it could be worse than that.
No, but what I'm saying is, okay, you predict in some future date, 12 months out, the Fed comes to us and says, hey, we're wrong. I'm not going to say that, but inflation's more persistent than we thought because the price of oil went up or something like that. That would be negative for equity prices. But then that might be 12 months away. Okay, so basically the next 12 months might be good for equities, but then the following 12 months might be bad. Is that sort of what you're saying?
Well, I'm not saying that the Fed's statements or change of mind or views or in any way do anything. Yeah, they might, but I have no idea how to measure that. What's important is whether the oil price goes up or not. And I believe it's very, very, very likely that the oil price will go up, but we have to have a calming down in the Middle East and Ukraine in order to achieve it.
You talked about the VIX. Anything more on the VIX?
Well, yes, recently, as I mentioned, I've been using the VIX to explain the behavior of the GDP, which is, I don't know who else may have done that. I'm sure somebody's tried somewhere, but I was surprised a little bit by the results, and I can show you where they are. Here we have a graph on a monthly basis. You can get monthly GDP from the private sector. You can't get it from the government. But you find that the ups and downs in GDP, quarter to quarter or month to month, can be explained to a significant extent by VIX. So this relates to your question. What else does VIX do? By the uncertainty that VIX represents, it makes it more difficult for the economy to do its job. The more uncertainty, the more difficult, and the more the actual GDP falls below the possible GDP. So you see here the red line is adjusted for VIX. This is a calculation of what the economy would have done, what real GDP would have done month to month if the VIX had never changed. And the actual, of course, is a little bit different. You see the actual trough in the middle of the pandemic was deeper than the red line. And that's because there was a lot of uncertainty during the trough. And the uncertainty was making everything worse. And the uncertainty has kept going, and it still exists today. So the red line is more smooth than the blue line in this graph. And I have this is not the only graph I could show you, but this is the best one.
So you ever look at unemployment? I've seen these interesting charts. I had a chartist that I knew that Stan Harley, and he would plot unemployment. And whenever you went from low employment to slightly increase in unemployment, that was like a negative indicator for recessions. Anything like that you've studied?
I look at employment rather than unemployment. The reason is that unemployment is rather artificially defined by the government as the number of people who are seeking unemployment benefits but remain in the labor force because they're still looking for a job. It doesn't include the people who are not looking for a job. So there's a lot of ambiguity about it. But if you look at the total number of people who are employed, that's much more unambiguous. You see there the graph we were looking at for GDP. Employment is in the blue line. And as you would expect, employment dropped with the pandemic, just as GDP did. But it grew afterwards, just as GDP did, and in a more stable way than GDP did. So a good deal of the GDP ups and downs are due not to the employment varying, but to the ratio between GDP and employment. In other words, productivity is explaining why GDP fails to get to where it could be. Employment really doesn't explain much of that. Employment is very predictable. Unemployment might explain it, but as I say, you can't really measure unemployment unambiguously.
Do you think we're headed for a recession?
No, I haven't, not since the pandemic itself. I haven't. We're in the bounce back from the pandemic. We're in the very late stages now, and there's no sign of anything happening in this or any other graph that I have that suggests a downturn coming up. But a downturn can always happen when you have a big surprise. It won't happen without a big surprise. You can't use the money supply to forecast that we're going to have a recession. You can't even use VIX. The amount that VIX would have to go to would be probably triple digits to get a recession. You're going to feel the recession in lots of ways without worrying about the VIX index.
Yeah, maybe the cause of the recession is if people keep projecting inflation lessening and it doesn't. So I know you've come on the show and talked about different countries you've liked. What countries do you like now?
As you see, the title is How to Anticipate Top Emerging Market Performance. I believe emerging markets are very unpredictable for the most part, but there are some particular situations where emerging markets I can do very, very badly or very, very well, and they need to be studied. And the factor that drives them is the currency. And that's what this paper is all about. So I show a list here of emerging markets. There's the change in the currency relative to the dollar as of the middle of this year. And there's the change in the previous year in the second column. And the difference between the two is the direction in which the currency is moving. Is it stabilizing or is it getting more unstable? And Pakistan happens to be the top line of the table. We've got this 3.1 for the most recent year, but the year before it depreciated by 28.5%. So that was a major step towards stabilization of the currency. So
that means you might want to consider investing in a Pakistan ETF or something like that.
Yes, you would have to know in advance that the Pakistan currency would stabilize. This is based on ex post, in this table. But you see there what happened to the Pakistan stock market. I'm making the point that this is a very important factor in explaining the stock market. An 85% advance in the past 12 months, June to June. So the question is, how do you anticipate when you're going to get a big stabilization? And you might be able to do that by watching the politics. But in the end, I do it by looking at how bad the depreciation was in the most recent year. And the worse it was, the more scope I believe there is, politically driven, to stabilize. And so what you have in this table, the bottom of the list is Argentina, where we had a 71.9% currency depreciation June to June. I would argue that is the largest scope. And since we've had a change in the Argentinian government as well, that's obviously a sign that the effort to stop the inflation is happening. That is the best performer in the next 12 months. I would put Egypt in second position, Turkey in third position, working from the bottom of that table, table 3.
Meaning Egypt, Turkey, and Argentina would be the ones you would want to invest in or the ones you wouldn't want to invest in?
They're the ones I would be invested in because they're in their worst situations with the currency having depreciated.
What's interesting is I'm looking at an Argentinian ETF. It's already up 27%.
Yes, it's been rising before now. That's right. And I believe it'll have another big return in the coming 12 months. A lot depends, of course, there's a lot of uncertainty. A lot depends on whether Milei will be successful in what he's attempting to do. He isn't dollarizing, that's clear, but he's on the right track. I believe if everything goes according to what Milei wants to do, then Argentina will have another roaring year.
Yeah.
So that's the answer to your question. That's how I do it. I don't look at small changes. I look at big changes in the most important factor that drives something. And I believe that to be the currency, just as it is in the US.
Argentina, Turkey, Pakistan, and Egypt?
Well, table 3 shows them all. Argentina is at the bottom of the list, and that's the highest prospect of an improvement, followed by Egypt, followed by Turkey, followed by Brazil. When you get to Indonesia, the next one, that's not a large enough number to motivate me to invest in something. I would draw a line between either Turkey and Brazil at 20 or so, or between Brazil and Indonesia at about 10.
Yeah, and then again, we're not giving you any buy or sell recommendations over the airwaves, but just curious as to what the good doctor says. Any other things to avoid in investing right now? Things you don't like?
Well, if you see a government change hands and the winners want to depreciate the currency more, then that would be something to avoid.
Any opportunities we didn't talk about that you like in investing?
The time to invest is when things just hardly can get any worse. And you know how unpopular inflation is. It's not just in the US where it's unpopular enough, but in a country like Argentina or Egypt or Turkey, it's incredibly unpopular, enough to overthrow governments. And if you count on that happening or that political events moving in that direction, then currencies will always tend to stabilize eventually. You might say this is an optimistic point of view, but it's always happened historically. You had depreciations that occurred, and some of them have been enormous, but they always stopped. Somebody eventually went in there to stop it from continuing. That, I think, is an opportunity. When it's been as bad as it seems to be able to get, that's the time to buy.
Yeah, but part of what you're saying, though, is if inflation is truly persistent, I'm taking that as a negative read. So as I'm digesting everything you're saying, not that you ever pinpoint days, but just based on kind of following you over these years, next 6 months, 12 months, it may look like inflation is cooling, but sometime in the next 6 to 12 months, inflation will rear its ugly head. Is that fair to say?
Yes, my best guess is always that it'll start rearing its ugly head right away, but it's very, very uncertain in the short run. So if you allow me a year, then I'm very confident that inflation will be a good deal higher, and the price of oil driving it will be a lot higher a year from now.
And what's interesting is when I look at oil stocks and oil ETFs, they've held pretty firm. Like they've not gone down.
Well, they fluctuate. The price of oil fluctuates incredibly. I watch it on a daily basis. But you're right. Over a 6-month time frame, from the beginning of this year to now, which is 7 months, we've got an advance in the price of oil. I think that's going to continue, but it's only a small part of the advance that has yet to take place.
David, where can people find out about your work?
Try our website, hcwe.com. There's a lot of information on the website. And I think my email address is even there. So you can contact me personally. And I don't have enough people chasing me to worry about being harassed by it. So I enjoy having people contact me. I am very happy to explain anything that may be puzzling in what I've said.
Wonderful. David Ranson, HCWE Research HC.
Yeah, the website is www.hcwe, that's Henry Charles Wainwright Economics.com.
Wonderful. So go there and subscribe to his very interesting research. Thank you so much, Dr. Ranson.